How's it going, everyone? Welcome back to another episode of the Investment Hound podcast. On today's episode, we're going to be continuing on in our portfolio building journey. So if you haven't seen last week's episode, in last week's episode, we looked at the different indicators that I'm going to be using to pick my first 3 shares. Okay, so for those of you that don't know, Grandad and I are going to be building a portfolio with a combination of 14 shares where he picks 7 and I pick 7. And in today's episode, we're going to be looking at the first 3 I picked using indicators from last week's episode. A really interesting task that I was given. Again, I want to point out that the numbers from these shares may be slightly different from what they are today as we recorded this episode a few weeks ago. But don't be worrying about that, because we are going to go back and reanalyze the shares and then make adjustments where needed. So hopefully you enjoy the podcast. Thanks very much for coming back and watching another episode of us. And hopefully you learned something. Have a good one. Okay, so let's jump into the first share that I had picked. So the first company that I had picked is Whitehaven Coal Limited. So Whitehaven Coal Limited were founded in 1999 in Sydney, Australia. They are Australia's leading coal producer, and they engage in the development and operations of coal mines. So the firm does open cut and underground operations where they mine thermal coal, so the normal coal that we all know, which is mainly used for generating electricity. And they also do metallurgical coal, which is coal used for the production of steel. So their coal is highly sought after for its unique properties, such as delivering amongst the lowest carbon emissions per ton of coal consumed in the seaborne trade, and the majority of their sales go to Japan, Taiwan, South Korea, and Malaysia, with Japan having 60% and Taiwan having 12% of that. So their primary listing is in the Australian Security Exchange. Their market cap is 6.5 billion Australian dollars. Their price is $7.80. Their dividend yield is 6.3%, which is good, so it's above my 6% indicator. Their payout ratio is 35.5%, which is good, it's less than 50. The PE ratio is 5.6 times, and the industry average PE ratio for the mining industry is 6.5 times, so that's good. And then beta, which I didn't discuss before, but their beta is 0.44. So Grandad, do you want to explain what beta is?
Well, let's say you buy a share that has a beta of 0.4. If the market increases by 10%, the share increases by 4%. If the market falls by 10%, the share falls by 4%. If, on the other hand, as I did in the book describe Ford Motor Company, I can't remember what their beta is, but it could be kind of, say 14. So that means if the market goes up by 10%, Ford Motor Company goes up by 14. And if it falls by 10%, Ford Motor Company comes down by 14%.
So I didn't mention that in my indicators, but the beta the beta threshold that I used was 1. So I didn't invest in anything that was above 1, as that would mean that it's a bit volatile towards the market. So then the next indicator for Whitehaven Coal Limited was their analyst ratings. So that was a consistent buy. And that's basically it. So there are the indicators I use. So what's your thoughts on Whitehaven Coal Limited, Grandad?
Well, I can't disagree with any of the indicators that you've used, broadly speaking, okay? The issue that you haven't taken into account is the industry that they're in. They're in the business of mining coal. We're supposed to move away from fossil fuels. So I have that gives the share a slight smell to me, an odor that I'm not pleased with, which dampens my enthusiasm for the share. If I can get a share that doesn't have a smell and has similar metrics, why wouldn't I buy that share rather than buy one which has that bit of a smell? I think of, and of course it's unfair, but I think of mining companies as having people working down underground and coming up with black faces, and some of them dying in accidents and so on and so forth, and then them wrecking the ground. It's not part of the green agenda, and I do support it when I can. If I can't support it, I mean, there's a limit to my support. It's a very minor support that I have. But why would I go into something that has ESG problems when I can go into something with similar metrics that don't have ESG problems?
Yeah. So for our listeners at home, we had a brief discussion about this during the week, because this was something that actually came as a shock to me. That, and this sounds bad when I say it, Grandad, but Grandad has ethical morals when it comes to investing in companies, which actually came as a shock to me, because it was never even something that dawned me, because the way I view it is kind of like that this is a game, and you just kind of get in, make your money, get out. It doesn't really matter what kind of effect you have. But I was thinking about it the other day, and it is important because we did disagree on this, because I said that I wouldn't have thought of that, and that wouldn't come into or be a consideration for me. But I was thinking about it the other day, and when you're investing, you are buying into these companies, and you are supporting these companies by buying their shares. That's how they raise
you
capital.
asked me, if you remember, you did ask me, would I buy Lockheed Martin? And Lockheed Martin makes weaponry.
Yeah.
And I said, well, why would I invest in a company that enables people to kill each other when I can invest in a company that doesn't do that? And I think you had you kind of agreed with that more than the coal company discussion. But I mean,
sure.
Everybody has something somewhere in the back of their mind that every now and again, and I think I described it to you, that when I was writing the book, I was writing about Irish shares. And the Irish shares did quite well for me. But I did admit at the end of that chapter that there was, in fact, one share in the Irish market called Paddy Power, which is now called Flutter, which is one of the biggest gambling companies in the world. And it was performing exceptionally well. And out of its socks, it was going shooting up the whole time. And I couldn't invest in it because, as I said to you, sometimes your conscience can get in the way of a good deal. And I just kind of feel that a lot of gambling companies have caused a lot of addicts to go awry. And so it had a smell of it, so I couldn't invest in it. But I did admit that if I had invested in it, I would have done better. And I put that in the actual book. But my editor, who was a young lady, said he shouldn't be giving out about Irish companies if he wants to sell this book. So she took it out. And she never told me she took it out. And it was only when the book went off I discovered that my one little small comment in relation to ethical investing didn't make the cut, as they say. Yeah. And there's nothing about ethical investing in the book. So it's great to be able to sort of air the issue on the podcast.
I would be interested to hear what the listeners at home have to think, or excuse me, what their opinion is on ethical investing, because I'd say if up to date, it wouldn't have even crossed their mind, like mine. I said to you the other day in the phone, Grandad, that every single day we do this, I learn something new, or every single day we plan for this or prepare for this, I learn something new. And ethical investing was definitely a shock to me when you had said it the first time. So I'd be interested to hear. So actually, if you're a listener at home, and depending on where you're listening to this, leave a comment down below or wherever you can leave a comment on what your thoughts on ethical investing are. Okay, so what would you rate that share anyways, Grandad?
Well, certainly from a commercial point of view, it seems to be good. The only worry I have is that it has a very low PE ratio. It's only around the 5 mark, okay?
Yeah.
So is it suggesting that the earnings are going to fall? And then the other thing I discovered about it was that they expect the dividend next year to be cut by 75%. So I'm a dividend chaser. So that would give me warning bells. But I like your approach to the share. And I've learned from it, obviously.
it's also important for me to note there that one of the mistakes I made when I was picking these shares was that I didn't look at any market news in relation to the share. So all I did was look at the hard financials and the industry, and the company it was operating in, and that was it. But as you said, Grandad, you need to look at what's coming. What do the people predict is coming in the future for it, So I didn't see that there was going to be a 75% cut in the dividend yield. So that would have been a mistake if I were to have invested in it. I could have been hit by that, So it's important to check past, present, and future. I think when you're doing these tasks.
Yeah, and also, what kind of industry are you investing in? Are you investing in a smelly industry? Or are you investing in one in a fragrant one that has a lot of nice fragrance?
Yeah. So speaking of fragrance, then that leads us nicely into the next one. So the next one that I picked was CVS Health Corporation. So CVS Health Corporation is a health solutions company which engages in the provisions of healthcare services. Or the provision of healthcare services. So they operate through the following segments of healthcare benefits, health services, pharma and consumer wellness, and corporate. And they're a well-established network of pharmacy locations across the US. So if you're listening to this in the US, you probably have a CVS near you. And it's not an ad. We're not sponsored by them. So they list in the New York Stock Exchange. Their market cap is $69.9 billion US dollars, so big company. Their price at the time of me picking this was $55.68. Their dividend yield here is 4.78%. Their payout ratio is 44.64%, which is good as less than 50. The PE ratio here is 9.78 times, and the industry average here was 20. Their EV to EBITDA ratio is 6.8 times, and the industry average here was 19 times, so it's well below it. Their RSI is 19, so they're a buy signal. The analysts rated a buy, and I think the strong financials here are a good signal to buy. What's your thoughts on it, Grandad?
Well, can we go through the first one? Was the PE ratio? Is that the first one you said?
The first one I said was the
dividend yield. Yeah, the dividend yield is a little bit low.
Yeah, it's a little bit low under my indicator.
But you have to understand that when shares are falling, the dividend yield is a function of the market price compared to the dividend. So let's say you have a share that has a market price of 100 and a dividend of, say, 4. So it's a 4% dividend yield. If that market price falls from 100 to 80, well, actually, you're now in a situation where your dividend yield is 5. And if it comes down to 50, the market price, your dividend yield is 8%. Okay? So that's why you're looking for shares that are falling in line with the market. And as they do, their dividend yield is rising. And then that's the rationale for looking at the dividend yield and trying to get a dividend yield, in my case, over 5, in your case of over 6. That means you're looking for a share that's down a bit. Okay. Now, what was the second one you had? The PE ratio, or the payout ratio. Yeah, it is a sustainable dividend yield at 44%. And they are putting extra money in. Right, go on from there.
PE ratio was 9.78 times. Industry average was 20.
That's cheap. Yeah.
Yeah. EV to EBITDA was 6.8 times, which the industry average was 19.
Yeah, very cheap.
The RSI was 19, so a buy signal.
That bothers me. If 30 is the point where people jump back into a share, and this has fallen from 30 down to 19, and not enough people have jumped back into share to bring it back up to 30 or 40 or 50, right? I'm now beginning to worry that maybe there's something about this share that the market's not happy with. Go on.
Okay, interesting. And that's basically it.
In other words, it can be too low, can't it? Did you not look at the analysts for this one?
Oh, I did. Sorry, the analysts were a buy as well, yeah.
Are they a strong buy?
No, just regular buy.
Yeah.
I also want to point out that this company operates within the defensive it's a defensive
Yes.
stock,
Yes, it is.
which
Yeah.
is a good
Yes.
area or a good way to diversify the three
Yeah.
shares that I picked. So the first one was a cyclical, this is defensive, and then we'll look at the third one in a minute.
Were you, when you looked at the company, and remember now you don't have a huge amount of experience of life at the age you're at, okay? But you assumed that CVS Health would have a shop near you. Are you sure they're business to consumer and not just business to business?
Yes.
Are you sure they are? Yeah.
Yeah.
Are you? Well, I can't
They
understand.
do pharmacies. They're like pharmacies.
Yeah, okay. So I can't understand why the RSI is 19,
Well, is that not a good thing
It's too low.
for an investor?
It's too low.
Too low.
People should jump in at 30.
Okay.
That's what the way the RSI works is they have looked at at investor behavior over the last 40 years or something like that. And they discovered that investors tend to be very attracted to a share when it goes down to 30 and tend to sell when it gets up to 70. And that's based on investor behavior. But down to 19, either there's something wrong with that RSI or something wrong with the company. I'd wait until it got back up to 30 myself.
Oh, interesting. Okay. So maybe this is where the mistake where I didn't look at the market news in relation to CVS. Maybe that's
there may be something in there that would bother you.
Yeah.
The other thing is that the dividend is going to come down next year, because I know you didn't look at that, but it's going to come down by less than 4% next year, which is, a bit comforting compared to the other one coming down by 75%.
Yeah. So what would you rate that? Would you buy that or would you not?
I'd wait to see if the RSI went back up.
Okay.
I don't have to buy it today or tomorrow. That's the other thing to bear in mind. That if you want to invest in shares, softly, slowly, catchy monkey. You don't have to rush into it. You can always give it a bit of time if there's something that just slightly is kind of stopping you buying the share. Give it time to adjust. And if it doesn't, then don't. And if it does, do.
So let's have a look at the third share then. So the third share that I looked at was Volkswagen. So we all know Volkswagen, the producers of cars. They make cars. They've been making cars for decades, and they're listed in the Deutsche Börse exchange, which is the German exchange, Grandad, isn't it?
Yeah. It's a Frankfurt, yeah.
So their market cap is 63.8 billion euro. So they're a big company as well. The price at the time of me picking this was 135 euro and 30 cents. The dividend yield was 6.63%. So that's good, above my indicator. The payout ratio was 30%. PE ratio was 4.5 times. And then in the car manufacturing industry, it's 20 times the industry average. So that's good. The EV to EBITDA ratio was 5.3 times. And the industry average in 2023 was 5.5 times. The RSI was 42.9, and the analysts rated a buy as well. So what's your thought on Volkswagen?
Well, you said it was 125, is that what you said?
135.
135. Do you know what it was yesterday?
No.
115.
Oh, nice.
Now, how would I view that? I'd view that and I'd say to myself, if I found it attractive at 135, by golly, I'd find it even more attractive at 115. Yeah. Okay. I'm just upset that I didn't buy it at 115, right? It has been coming down. And the issue is there must be some concern that Volkswagen have problems. Okay. Now, there may be articles that are saying what those problems are, but the analysts have rated it a buy, have they?
Yes.
Yeah. So, and obviously the dividend yield of 6.3 or 6.4, it's over 7 now. Okay.
Oh, nice.
So it looks a lot sweeter. Okay. I did look to see what the dividend would be next year. And it says unknown.
Oh.
Now remember, if you're running a company, you want people to invest in your company. And if you were not willing to give them any indication as to what the dividend would be next year, any indication, that's not going to attract investors. So I think in your case, I think I'd wait. Well, first of all, one can do one or two things. You could wait until that unknown becomes known. Because I know that when I bought the shares, it wasn't unknown. The dividend for next year wasn't unknown. They were saying something, but they're no longer saying anything, which is a worry. But the other thing is, I look to see what the track record of this company is. And my sons each of them bought an electric car in the last year. One bought a Hyundai and the other bought a Volkswagen. And I was counting the number of Volkswagens when I was walking up the hill to my house last night. I'm living in a housing estate, and there was houses going up the hill. And there was 7 cars parked on the hill. Now, this is a very small survey. 5 of them were Volkswagen. I couldn't believe it. Now, I don't have a Volkswagen. Okay, I have a Skoda. But surprise, surprise, Skoda is a subsidiary of Volkswagen. And one of the cars that wasn't a Volkswagen on the hill was also a Skoda. So 6 of the 7 cars on the hill were Volkswagen. So they have a tremendous record. And then in the United States, the Audi car is a very popular car in the United States. So they have a good penetration in that market, which is a very big market. And obviously they have a good penetration in the European market. So I took the view that we should, trust the management. They're in the business of facing into a changing world where you have to move to electric cars and where they have to move to driverless cars and so on. Why would I think they would make a mess of it compared to other companies? They have a long record of not making a mess of things. So I would be holding on to my share and confident that my 7% or whatever it was dividend yield, well, I'll get that this year anyway. Now, maybe next year it might come down to 3.5%, but I'll stick with them.
Yeah.
If they cut the dividend in half next year, because I have a couple of lots, I'd sell one lot of my dividend shares and continue to believe in the company. So this is an example where I believe, my gut says, this is a company that will do well, rather than the metrics all being right.
The company does have a lot of pedigree as well. I remember you telling me before they've been around since the 1940s or something like that.
No, I told you that the first guy to bless the first Beetle coming off the production line was one Adolf Hitler. And I think that was around 1937, 38. So they're around for a long, long time, and they've been a very good company. Why would I think they're going to go to the wall next year? I don't think so.
So that's all my 3 shares anyways, okay? I think the biggest learnings from this was that maybe I should have looked more at the future predictions and the news. Not maybe, definitely. I should have looked more at the future predictions from analysts and the news. And
yeah, in other words, recent news articles.
Yeah. And not have been so focused just solely on the hard, cold financials of now, What's your thoughts on that?
Yeah. Because in the book, when I give you the checklist for shares, the first thing I put down is the company's strategy. What are the obstacles facing the company in the future, and what are they planning to do about them? So, and management, how do I feel the management of the company is good? So these are all, if you like, soft indicators as distinct from the hard financial indicators. So you have to look at the thing in the round. Now you can get it wrong, as indeed you'll find that you will get wrong decisions, but you're hoping that the right decisions exceed the wrong decisions and some.
Well, I probably avoided that. Like, let's say I was actually going to invest in these companies. I probably avoided making a wrong decision on which one did you say, Grandad, was it CVS or Whitehaven Coal Limited that you say was going to cut the dividend? Whitehaven Coal, was it? I was going to cut the dividend?
74 point something percent according to the analysts.
Yeah.
And
So
you
let's
see,
say
and they're also saying, it's trading very cheaply. So there's some degree of uncertainty about the future there. So I'd wait to see if that 74% changes. And similarly with Volkswagen, if I had a choice to invest today, I'd wait to see, get some indication of what they're talking about the dividend for next year. In other words, take your time.
Okay, I think we'll wrap it up there, Grandad. Is there anything else you want to say?
No, have a nice day.